Chapter 2, Accounting for Managers. I will let you read over the learning objectives for this chapter. In this chapter, we're going to learn how to take all of the transactions of a business, all those pieces of paper, the invoices, the checks, the deposits, and get those entered into our accounting records so that we can produce financial statements. Now, in Chapter 1, you had a little bit of experience in creating financial statements, but we did not talk about where that information came from. And it's very important that you know how the information gets from point A to those financial statements, because we will be using that information to analyze and review our financials. Now, we don't just make up things as we go along. There are rules on how and why and when we record the transactions. We've developed a framework. It's not a true accounting framework. We're not using journals and ledgers and such. We have a framework to help you understand how the information is developed and controls to help us determine if the information is correct. The rules tell us what, when, how, and how much we're going to record as we do our transactions. A transaction is an economic event that affects parts of our financial statements, plural, not necessarily each one of those statements. A transaction, I want you to note this, is an economic event. It is not a contract. Let's say I hire you to be a manager in my business and I offer you a contract for $40,000 a year. That's not an economic event. The economic event occurs when I give you your first paycheck. So let's just be clear on what a transaction actually is. The accounting equation is assets equals liabilities plus stockholders' equity. This is important. This is something you will use throughout this textbook. So remember this. We're going to expand that accounting equation because that is just the basic, the framework. So we're going to expand that stockholders' equity section. Why would we do that? Well, let's look at the original equation. Assets are things we own, liabilities are things we owe, and stockholders' equity is the combination of capital stock and retained earnings. Retained earnings are the profits that are retained within the business that we have not paid out in dividends. Well, there's something missing. Where's revenues? Where's expenses? Where's that piece of daily operations? That's why we're going to expand this. Stockholders' equity equals capital stock plus net income, that's the part of retained earnings, less dividends. And then if we look at what net income is, that's revenue minus expenses. There's our operations piece. So it's part of the accounting equation. It's just within that equity section. We will be using spreadsheets to enter our transactions and develop our financial statements. The way the spreadsheet is set up, we can make all our entries and take the information and put it into the section that will be used for our financial statements as we move through an accounting period. It's all integrated. May not make much sense right now, but as we move forward, it will. Now, we talked about controls. We'll talk about a lot more controls as we move through further chapters, but for now, the accounting equation must always be in balance. Do you remember that equal sign between assets equals liabilities plus equity? That must always be in balance. That's how you know you've entered your transactions correctly, as long as that stays in balance. So if we have two assets, that must equal a combination of liabilities and equity that also equals 2. Also, on our statement of cash flows, the ending cash must equal the cash on the balance sheet. On our net income statement, or our income statement, the net income on the income statement must equal the net effects of revenue minus expenses on retained earnings. So hopefully those are a few things that can help you make sure you're entering your transactions correctly. So let's look at starting family health care. Very first entry. Dr. Landry deposits $6,000 in a bank account in return for shares of stock in the corporation. 2 questions you must always ask. What am I doing and why am I doing it? What am I doing? I'm putting money in the bank. Why am I putting money in the bank? Because there was a stock purchase. So our very first entry, we're going to increase our cash and increase our capital stock. And as you can see, that entry balances. Also, because we're affecting the cash account, there's going to be an entry in the statement of cash flows. And you can see that right here. Next, the company borrows $10,000. Borrowing money is not revenue. Revenue comes from doing what you're in business to do, selling services or products. So a loan from a bank is a liability because it must be paid back. So in this case, we're going to increase our cash by $10,000, increase our notes payable by $10,000, and again, we'll have an entry on our statement of cash flows. Everything that flows in and out of that cash account has a place on the statement of cash flows. Now we're going to buy some land. Land is an asset of the company. It's something the company owns. So we're going to decrease our cash by $12,000, increase our land by $12,000. I want you to note both of these entries are under assets, but the accounting equation still balances. We have not changed our total assets. We've merely changed the makeup of those assets. We've reclassed some of our cash from cash to land. Family Health Care earned fees of $5,500 and received cash in payment for all of their services. So we're going to increase our cash, which, as you know, involves also an entry on our statement of cash flows, and we're also going to increase our retained earnings. This is our first entry on our income statement because the $5,500 came from operations. Then the company paid expenses during September. They paid all of these in cash. So we're going to decrease our cash. Don't forget our entry on the statement of cash flows. And we're going to decrease our retained earnings. Revenue increases retained earnings. Expenses decrease retained earnings. And you can see on the income statement portion that we have entered the individual items. Other than the miscellaneous expense, they're entered with the largest amount first. Then the company is going to pay dividends. Now remember, dividends are not an expense. They are a means by which the company pays back to its owners some of the profits of the company. It will appear on the statement of cash flows, but not on the income statement. This is a view of the whole spreadsheet as we've just entered the transactions that we talked about. You can see that all of the information that we need to develop our formal financial statements is now right here in one place. Obviously, these aren't the formal statements. This is the working document from which we can then produce our formal financial statements. We have our balances for our balance sheet. We see that our cash balance equals the balance on the statement of cash flows. And we also see that our net income equals the difference between our fees earned and our expenses that we paid. I've already mentioned this, but stockholders' equity increased by the company selling stock, decreased by dividends, increased by revenue, and decreased by expenses. So now we can take this information and prepare our financial statement. Okay, income statement. We've taken the information that we looked at on the spreadsheet and just presented it in its formal way. Statement of retained earnings. Because the company just started in business, there is no beginning retained earnings as there will be as we prepare future financial statements. And the balance sheet. And the statement of cash flows. Now you'll note all of these statements take the information from the spreadsheet and in some cases combines them and then presents them in the format that we have learned. And we can see here how all of the financial statements are integrated. So let's look at the second month of information for the company. We have in front of us the spreadsheet. Now note this first line, balance forward. These are the balances from the end of September. It is important on the balance sheet portion that we start out with the beginning balances, because those accounts are a record of the business's financial position from day one. The income statement and statement of cash flows, of course, are just for the period. So we can see that the company earned some additional money, paid expenses, and paid some dividends. So by taking this information, we can once again prepare the financial statements for the second period. We have the income statement, and remember, this is just for the month of October. The entries from September do not come into play here. Our statement of retained earnings, and note, we have beginning retained earnings, which we did not have in September because it was their first month in business. Our balance sheet and our statement of cash flows. Once again, you can see how these are all related to each other. Common-sized income statements. These are a very, very useful tool, especially when you are comparing your company to other companies. We don't want to give away financial information. And besides, if I'm comparing my small accounting firm to some large Pittsburgh accounting firm, the actual dollar amounts are not going to be useful in a comparison. So by expressing our financials as percents, we can make comparisons. What we're going to look at is expressing all of our amounts as a percentage of sales. What percentage of sales are my wages? What percentage of sales are my utilities? Then we can do comparisons with companies of any size. On our balance sheet, assets are expressed as a percent of total assets, and liabilities are expressed as a percent of total liabilities. All right, here are comparison financial statements, and these are useful in not only comparing our company to other companies, but also from year to year. Remember, sales is the base, that's 100%, or the denominator. Our numerators are each of the line items. And we can see here by looking at the percentages the changes in the various accounts. Now in year 2, the net income for the company was much lower. So we need to ask ourselves why. Well, our sales were greater. Shouldn't that mean we have a higher net income? Well, no. Look at our cost of sales. as a percentage, it's a higher percentage than it was in the year before. So we can see how that causes us to have less in gross profit as far as a percentage, and we can start doing some analytical work. And you can see the relationships between the various line items and the totals. And that is the end of Chapter 2. If you have questions, please post those on the discussion board. Thank you.